This was not financial advice.
Ever pondered upon the strategies that successful investors employed during past recessions? The road to wealth is paved with setbacks. Yet, some investors have managed to navigate these tumultuous times with finesse and emerged victorious. Today, we're diving headfirst into the past to explore the investment strategies employed during three major economic downturns: the dot-com bust, Y2K, and the housing market crash. So, rewind to the late 90s, when the internet was gaining momentum and tech stocks were the talk of the town. Enter the dot-com bust. The bubble burst when it became clear that many internet companies, or dot-coms, were overvalued. Despite the economic downturn, some investors came out on top. How? They focused on the fundamentals. Instead of getting swept up in the dot-com craze, they invested in companies with solid business models and strong financials. They demonstrated that even in a sea of uncertainty, a focus on fundamentals can lead to success. Fast forward a couple of years to Y2K, the year 2000. The fear of the millennium bug led to widespread panic and economic uncertainty. Amid this chaos, some investors found a silver lining. They anticipated the increased demand for tech solutions and invested in technology and software companies. These investors recognized that fear often breeds opportunity, and they acted on it. Now let's time travel to the mid-2000s, when the housing market was booming and then, abruptly, it wasn't. The housing market crash led to one of the worst recessions in history. But again, some investors weathered the storm. They diversified their portfolios, investing in a mix of stocks, bonds, and real estate. When the housing market crashed, their diversified investments cushioned the blow. So what can be gleaned from these historical events? Firstly, stick to the fundamentals. No matter the economic climate, solid businesses with strong financials are often a wise investment. Secondly, don't let fear cloud your judgment. In times of uncertainty, there can be a wealth of opportunity. Lastly, diversify your investments. By spreading your assets across different types of investments, you can shield yourself from the full impact of a downturn. In conclusion, investing during a recession might seem like an unfruitful idea. But as history has shown, with the right strategies, it's possible to not only survive, but thrive. So, whether you're an investor weathering a current economic storm, or an aspiring investor planning for the future, remember, focus on fundamentals, seize opportunities, and diversify your portfolio. As the old adage goes, when the going gets tough, investors start buying. And that, dear viewers, is a wrap on our journey through the investment strategies of past recessions. Until next time, keep investing wisely. And remember, every setback is a setup for a comeback. None of this was financial advice.
This was not financial advice.
The intriguing concept of a Bitcoin squeeze. Let's unravel this phenomenon together. A Bitcoin squeeze is a situation where the demand for Bitcoin surpasses the available supply. This is largely due to spot Bitcoin ETFs, which are purchasing more Bitcoin than is being mined each day. Now, this might seem like a simple case of supply and demand, but it's much more nuanced than that. The key to understanding this lies in the unique feature of Bitcoin, the halving. The halving, which takes place approximately every 4 years, is a process where the reward for mining new blocks is halved and the rate at which new Bitcoin is created decreases. This essentially squeezes the supply of Bitcoin, while demand continues to increase. Now, imagine a scenario where large spot Bitcoin ETFs continue to buy more Bitcoin each day than is mined. With the halving in play, the supply diminishes further. This high demand and low supply situation is what forms the crux of a Bitcoin squeeze. And what happens when such a squeeze takes place? Well, as per basic economics, when demand outstrips supply, prices are driven up. This could potentially lead to a significant increase in the value of Bitcoin. However, it's important to keep in mind that the crypto market is highly volatile, and many other factors can influence the price of Bitcoin. So to wrap it all up, a Bitcoin squeeze is a situation where the demand for Bitcoin, driven by heavy Bitcoin purchasing by big institutions, outweighs the available supply. The unique feature of Bitcoin halving exacerbates this situation by further diminishing the supply. This imbalance between high demand and low supply could potentially drive up the price of Bitcoin, although the volatile nature of the crypto market means there are no guarantees. Remember, knowledge is power. Understanding the dynamics of a Bitcoin squeeze can provide unique insights into the workings of the crypto world and can be a valuable tool for making informed decisions. But as with all investments, it's crucial to do your own research and consider all factors before diving in. So the next time you hear the term Bitcoin squeeze, you'll know exactly what it means and how it works. Yes, it's about supply and demand, but it's also about understanding the unique features of Bitcoin and the impact it can have on the financial markets. This was not financial advice.
This was not financial advice.